So you've seen the headlines, right? The warnings about government finances, the mind-boggling debt, it all seems kind of unsustainable. Well, that's what we'd call the first order effect. It's the big, obvious storm cloud that everyone is watching. But today, we're going to go a level deeper. We're going to decode the second order effect of this whole global debt crisis. And trust me, that's where things get really interesting. There's this fantastic old Japanese proverb that goes, when the wind blows, the barrel makers prosper. And right now, pretty much every investor out there is totally fixated on the wind. You know, the debt, the inflation, the chaos in the markets. But the ultra-wealthy, they're not just watching the wind. They're looking for the barrel makers. They're trying to figure out who builds the stuff that actually profits from the storm itself. And that really brings us to the core question of this whole explainer. In the massive financial storm we're in today, who are the barrel makers? Well, the answer lies in this really specific, very physical infrastructure that's quietly being built out to create a parallel system, one designed to work completely outside of the traditional banking grid. Okay, so to understand who these barrel makers are, we first have to really get our heads around the storm that's making them so necessary. And it all boils down to one thing, a fundamental breakdown in trust. Trust in the very thing we all call money. The key concept you've got to grasp here is something called fiscal dominance. It sounds academic, but it's a very real trap that a lot of countries are stumbling into. It's when a government's debt gets so ridiculously high that its own central bank becomes completely trapped. See, they can't raise interest rates to fight inflation, because doing so would make the interest payments on the national debt so high it would basically bankrupt the country. And this dilemma, it plays out in a really predictable and kind of scary sequence. Step 1, government debt gets way too high. Step 2, the central bank gets trapped, just like we said. And what's the inevitable result? Step 3, the currency gets sacrificed to save the government. In that world, the cash in your bank account, the government bonds you thought were safe, they stop being safe havens. They actually become liabilities. And hey, don't just take my word for it. We are seeing the smartest money in the world react to this in real time. Just look at this chart. Central banks, the biggest players of all, have bought more physical gold in just the last 2 years than they did in the entire previous decade. But here's the kicker, the really crucial detail. They're not just buying paper contracts for gold. They are physically withdrawing the actual gold bars from vaults in places like London and New York. This isn't just an investment. It's a huge vote of no confidence in the system. So this great withdrawal of physical assets creates this fascinating problem, right? It's a bottleneck. What happens when literally trillions of dollars all try to rush for the exit from the digital system into the physical world at the same time? Well, that is exactly where we find our barrel makers. They are the industry that's solving this massive logistical nightmare of securing immense physical wealth. So who are they? The barrel makers of our time are the high-tech, private vaulting, and sovereign custody industry. We're talking about a new breed of companies building the hardcore physical infrastructure for a quiet, orderly exit from the traditional financial system. Now, to really get why this industry is so important, you need to understand the concept of counterparty risk zero. Think about it. A stock, a bond, even the money in your bank. It's all just a promise from someone else. It's an IOU. But physical gold, held in your name, that's different. It's one of the very few assets in the world that isn't simultaneously someone else's liability, and that makes it the ultimate safe harbor in a storm. And this brings us to a really crucial legal distinction that most people miss. When your money is in a bank, you're not an owner. You're technically a creditor. Your money is on their balance sheet. So in a crisis, you're just standing in line hoping to claim an IOU. But in a private vaulting arrangement, your legal status is totally different. You're a bailor, you retain direct title. It's your property. So in a crisis, you're not asking for your money back, you are simply collecting what is already yours. That difference is, well, it's everything. But this story doesn't just stop with storing gold bars in a fancy bunker. No, this whole network of high-tech private vaults is now evolving into something way, way bigger. We are literally watching the birth of an entire parallel financial system. This is the third order effect. The key innovation that's making this all possible is the tokenization of the physical. Now, hold on. When you hear token, your mind probably jumps to speculative crypto coins. That is not what we're talking about here. This is an institutional-grade technology for taking a real physical asset, like a specific audited gold bar, and issuing a direct digital title to it. This makes that hunk of metal instantly liquid and transferable, anywhere on Earth. And this new financial operating system is actually beautiful in its simplicity. Step 1, you secure your physical gold in a super high security non-bank vault. Step 2, a digital title is issued that represents that specific identifiable asset. And step 3, you can then trade that digital title instantly with anyone, anywhere in the world, with the final settlement happening completely outside the rails of the conventional banking system. So this all sounds like the perfect solution, doesn't it? A safe, liquid, totally parallel system. But, we have to do a reality check here. Is this new shelter truly as safe as it sounds, or are we just swapping one set of risks for another? And that brings us to the really important counter perspective. Is this a perfect hedge against the storm, or are there a whole bunch of new, maybe overlooked risks that come with stepping completely off-grid? Let's actually dig into the potential flaws. Look, this system is not some risk-free paradise. For starters, you've got geopolitical pressure. What happens when a so-called neutral country suddenly isn't so neutral anymore? Then there's a potential liquidity trap. You could be metal-rich, but cash-poor, right? Your wealth is safe, but you can't use it to buy groceries. And of course, you still have to worry about old-fashioned physical security risks and the pretty hefty fees for storage and insurance. And maybe most importantly, this brings us to a central contradiction, a kind of digital paradox. To make this physical gold useful and liquid, we wrap it in digital code. But in doing that, are we just taking a fundamentally unhackable asset and wrapping it in hackable code? Are we accidentally reintroducing the very digital counterparty risk we were trying to escape from in the first place? Ultimately, what we're talking about here isn't just a simple investment choice. It's bigger than that. It reframes the entire discussion into a fundamental philosophical shift in how we even perceive wealth, how it's secured, and how it's controlled. At the end of the day, it's really all about sovereignty. And this slide really nails that shift in perspective. The old era was completely defined by trusting the system. The value of your assets was based on promises and claims, IOUs. The new era that's emerging, it's all about verifying the physics. Value is based on provable, tangible, physical reality. So, as we start to wrap this up, I want to leave you with 3 core principles for this new era. Number 1, paper is a promise. Physics is a fact. Number 2, the infrastructure of the exit, our barrel makers, is often a much more profitable investment than the exit itself. And number 3, in a world where every government is trying to devalue its currency, true sovereignty over your own assets is the only real alpha left. And that really leaves us with one final and I think pretty provocative question for you to think about for yourself. In a world where the so-called risk-free asset, the government bond, is very clearly no longer risk-free, what percentage of your own wealth are you truly willing to keep exposed inside that traditional banking grid? It's something to think about.